Every single day, huge companies are making these massive billion-dollar bets. Should we build that new factory? Should we buy out our competitor? Or launch that risky new product? So what's the secret sauce? What's the hidden logic that tells them go or no go? Well, it actually boils down to one single incredibly powerful number. And today, we're going to pull back the curtain and show you exactly what that number is and how it all works. So, here's how we're going to tackle this. We'll kick things off with a weird quirk in how all of our brains make decisions. Then, we'll see how the world of finance came up with a pretty elegant solution called the price of capital. We'll break down where that capital actually comes from, solve the puzzle of how to mix it all together, and finally, we'll get to investing's golden rule, the one that governs every major decision. All right, before we dive into the corporate spreadsheets and the big finance talk, we need to start with something much more fundamental. It's a concept that trips up, well, pretty much everyone, from you and me to the experts in the boardroom. And it's all about the choice you didn't end up making. Let's start with a really simple question. Just think about the last coffee you bought. What did it really cost you? I mean, you're probably thinking a few bucks, right? But that's only part of the story. The real cost is actually hidden in what you had to give up to buy it. This whole idea is called opportunity cost. It's basically the value of the road not taken. See, the true cost of that coffee isn't just the money that left your wallet. It's the stock you could have invested, or the snack you could have bought, or maybe the savings you could have built up. It's like the ghost of your next best alternative. Now, you'd think this is pretty basic stuff, right? But what's absolutely fascinating is that research shows we are systematically, terrible at considering opportunity costs. And get this, it's not just a problem for us regular folks. Even seasoned experts, like those making huge public health policy decisions, often completely forget to ask, what else could we do with this money? And this quote from researcher Gustav Tinghog, I think it just hits the nail on the head. It tells us why this happens. So often, our decisions are driven by emotion. We just pick the option that feels the safest or the one that's easiest to explain, all because we're afraid of messing up. We're not really stepping back and analytically weighing all the alternatives. Okay, so if our brains are basically wired to ignore this super important concept, how in the world do massive corporations make rational, long-term decisions that are worth billions? Well, they build a system for it. They find a way to take this fuzzy idea of opportunity cost and turn it into a cold, hard number. I absolutely love this metaphor from financial journalist Edward Chancellor. It just perfectly captures the whole idea. Think about it. Companies want to spend money today to build something for the future. And investors, well, they have money today that they're willing to part with as long as they get a return in the future. Finance is literally the bridge that makes that whole exchange possible. And the toll for crossing that bridge? That, my friends, is the cost of capital. Now, here's the key takeaway. The cost of capital is really just the corporate world's fancy term for opportunity cost. It's the absolute minimum return a company has to earn on any project to make it worth it for the people who gave them the money in the first place, their investors. And this diagram, it illustrates the whole system beautifully. You've got investors on one side providing the cash, and they have an opportunity cost, right? They could invest their money literally anywhere else. The company takes that cash and has to generate a return that clears that bar. That bar is the company's cost of capital. If their project's return is higher, boom, they create value. If it's lower, they've actually destroyed it. Okay, so we've established that a company needs capital, but where does it actually come from? Well, broadly speaking, there are two main flavors of financing that companies can use to build and grow their business. First up, you've got debt. The easiest way to think about this is like a mortgage on a house. It's a loan. It has to be paid back with interest on a very strict schedule. The second kind is equity. Now, this isn't a loan at all. This is when a company sells a tiny piece of itself. The people who buy it, the shareholders, become owners, and they get a claim on whatever profits are left over. So let's think about who gets paid first if things go south. Debt holders are the lenders, so they have what's called a senior claim. They are first in line to get their money back. Their return is fixed. It's just the interest. Equity holders, on the other hand, are the owners. They get what's left over, the residual claim. Now, this means their potential return is theoretically unlimited if the company crushes it, but their risk is also way higher. If the company goes belly up, they could be left with absolutely nothing. And this brings us to a really fascinating puzzle. If a company can choose its own mix of debt and equity, what we call its capital structure, can it just magically create value by messing with that mix? First, we need to get two types of risk straight. You've got business risk. That's just the basic uncertainty of whatever industry the company's in. Is it a super stable utility company or a crazy volatile tech startup? Then there's financial risk. This is the extra risk that gets piled on top when a company takes on debt, because now, all of a sudden, it has these fixed interest payments it has to make no matter what. So back to our puzzle. Can a company actually make itself more valuable just by borrowing more money? A couple of economists, Franco Modigliani and Merton Miller, came up with a totally groundbreaking answer to this. And they said, in a perfect world, one with no taxes or bankruptcy costs, the answer is a hard no. And this simple table really shows their logic. Let's say you start with a company that's all equity, and it's worth $1,000. Okay, now the company decides to swap $200 of that equity for $200 of debt. Now, sure, that makes things riskier for the shareholders who are left, but look, the total value of the firm is still $1,000. As they proved, the pie is the same size, you've just sliced it up differently. But, and this is a really, really big but, we don't live in a perfect world. The Modigliani-Miller theorem is so powerful because it helps us see what matters in the real world. And the biggest difference? Taxes. Because interest payments on debt are usually tax deductible, adding some debt to the mix can actually increase a firm's total value. Okay, let's bring this all home. We've talked about opportunity cost, debt, equity, and risk. It all gets blended together into one single number that acts as the ultimate decision-making tool for any company. And that number is called the weighted average cost of capital, or WACC for short. It's exactly what it sounds like. It's the blended average cost of all the different financing a company uses, all its debt and all its equity, all weighted by how much of each it has. This WACC is the final concrete number that represents the company's total opportunity cost. So, for example, let's say a company does all the math and its WACC comes out to 8%. This 8% now becomes its hurdle rate. Any project they're thinking about, a new factory, new software, whatever, it absolutely has to be projected to earn a return higher than 8%. If they think it'll make 9%, that's a green light. You're creating value. If it's only 7%, that's a red light. You'd actually be destroying value. It's that simple. Of course, as this brilliant quote from Charlie Munger reminds us, the point isn't just to mechanically spit out a number. The WACC is a tool for thinking. It forces discipline. It makes managers stop and explicitly ask, is this new investment really better than all the other options our investors have? It forces them to confront opportunity cost head on. We started this whole journey with the simple cost of a cup of coffee, and we ended up with the golden rule for billion-dollar corporate investments. But the amazing thing is, the underlying principle is exactly the same. It's all about seeing that forgotten alternative, that hidden cost, in every single choice you make. So the real question is, what will you do with that knowledge?